let's see the advantages and disadvantages of the cash accounting method. Cash accounting is an easy method to use, and also it's subject to less regulation, and this is based on its simplicity. Okay, just remember that it's a method that relies only on cash related transactions. For the same reason, since it's based on cash transactions, this is a good method for recording accurately cash related transactions, meaning all inflows and outflows that relate to the operations of the business, such as sales, revenue, and expenses. Another advantage is that the cash accounting method would be a more appropriate method for businesses that do not operate on a credit basis. That means that it's a good method for businesses that pay expenses as expenses are incurred during the same period, and also they collect the revenue at the same time period that services are delivered to customers. Now let's go to see disadvantages of the cash accounting method. This method doesn't have the ability to record receivables. Remember, receivables are expectations that the business have from a customer to receive a payment from them. Okay, let's see an example here. Let's say you deliver goods to a customer in January, and the agreement between the business and the customer is to receive payment for these goods in February. At the end of January, there is no accounting record for the business of the money that is expected to be received by the customer. So the business has to rely, on its own personal record of the owner or the manager in order to keep track of this receivable that has to receive a month later. Likewise, another disadvantage is that the cash accounting method doesn't record any payables. Payables are obligations of the business towards others, let's say liabilities or obligations to a supplier. Let's see an example here. So if you receive goods in January from a supplier and you agree to make a payment of these goods in February, there is no record in your accounting books of this obligation. So again, in this case, you have to rely as a business on the personal notes or memory of the owner or the manager. Another disadvantage is when the business makes or receives partial payments. Let's say you have agreed to receive a payment from a customer in three installments, $1,000 in January, $1,000 in February, and $1,000 in March. Now, at the end of January, there is no accounting record that tells the owner or the manager of the business that there are still two more payments of $1,000 to be received in February and March. Okay, so the only record that will be kept by the end of January is the first payment that already has been received from the customer. So again, for the other two expected payments that the business is to receive from the customer, the owner or the manager needs to rely on his or her own personal records other than the accounting books. Another disadvantage is that there is no matching of expenses and the related revenue during the same time period. I remind you that expenses are a use of economic resource of the business. And remember, a business incurs expenses in order to create revenue. for itself. Okay, so let's see an example and how this happens according to this method. We have an advertising agency who works on a marketing project for a customer for the entire month of January. Now, all expenses for the agency's marketing project amount to $1,000. And let's assume also that the marketing agency pay all the incurred expenses by the end of January. The project is submitted to the customer by the end of January at a sales price though of $2,000 so that the agency can make a profit. However, even though the project is delivered to the customer at the end of January, payment for this delivery of project will be received in February. So in that case, the project's expenses of $1,000 will be recorded in January. Why? Because it was paid actually in January. However, its associated sales revenue will be recorded in February because payment from the customer will be received in February. So we see that there is no match of the revenue and the related expenses during the same period. And finally, another disadvantage of this method is that operations and results are not accurately recorded or are not accurately matched. Okay, I remind you here, operations means services, either provided or received for a business. And of course, results refers to operating results and relates to sales revenue and expenses. Okay, so let's see how this situation exists. For example, you sell and deliver goods to a customer in February at a sales price of $2,000. Payment for these services, operations, is received in March. So we see here that the actual operation services took place in February. However, sales revenue results will be recorded at a different time period in March. So there is no match of services in February and sales revenue since they will be recorded in March.